It's a great day in South Florida. My name is Chris Igoe. Welcome to Living in South Florida. If you're new to the channel, welcome aboard. And if you're a returning viewer, I appreciate you joining me in this journey. Today, we're going to get right into it because there are big things happening right now. There are leading indicators that on a daily basis present themselves, and we must know what they are in order to understand what is happening as we move forward into this recession, into this more challenging housing market that everyone is experiencing. And there are many moving parts. There are also ways to capitalize on market weakness, which I also want to share about too. And so as you can see, we got Ready Better. Where are you, buddy? Hey, pal. You want to be part of this video? Not really. He's wagging his tail. I'm wagging my tail. Let's get into it pre-market as the markets brace for the Fed rate hike, which is due out imminently, and how to capitalize on the Great Reset. So if learning more about that is your thing, then please keep watching. Boom, we're live. It is pre-market on Tuesday, and stock futures are already on the downtick, indicating a lower open, indicating a sell-off, indicating a weakness in the market in front of the Fed kicking off their meeting, which starts today. Now, with last week's CPI numbers, I think it's fair to assume that the Fed is going to go out there and raise interest rates or raise the Fed funds rate by 75 basis points. But I suspect, and I certainly would not be shocked, if it's a full basis point. Yet to be determined, I don't know. But what I do know is if the Fed funds rate increases, that will impact lending rates, mortgage rates, and your monthly payment if you're thinking about buying a home at today's interest rates significantly. And this is going to be a double whammy because there's a lot of economic news that's coming out this week. In fact, I expect this morning we will also receive August housing market data as it relates to housing starts and building permits. So we're going to have more information as it relates to what builders are doing, what new construction is doing, and how the pain of inflation is impacting them, their business model, and what opportunities that brings to you, the consumer, if you're thinking about buying new construction. Now, in the past, I've talked a lot about one of the premier builders in my market, and I'm referencing GL Homes. GL Homes is an incredible builder. They have incredible resort style communities. I live in a GL community. And as I mentioned in other videos, in South Palm Beach County, or really just in Broward or Palm Beach County, there is no more land, or scratch that. There's very little land to be developed that's zoned for residential construction. So both of these counties encompass an enormous amount of land, but that land is bordered by the ocean on the east and on the west by the Everglades. So there is a scarcity of resource as far as land is concerned. And almost all of that land has been maxed out, meaning there's no place to build. And I only share that information to give you context because thus far in my market, the new construction, the new developments, the ultra luxury communities that GL is building in this market still have massive demand. In spite of whatever the economic conditions are right now, there are plenty of ready, willing, and able buyers who are happy to pay a premium to live that lifestyle in those communities. Keep in mind, I am very close with the sales team at GL for their new community at Lotus Palm, and the demand for that has been insane. So the first batch of homes that were released or sites that were released via a lottery, they sold out instantly. And every time that I've talked to the sales team or tried to glean some inside information, which in the stock market is completely illegal, but in the real estate market, it isn't exactly inside information. But I want to get the best information so I understand what they think the market is doing and what they are seeing in real time, which could be very different than what I see. But thus far, they have indicated nothing but strength, nothing but demand. And the first section of that build out was sold out instantly. But to be perfectly clear, this community is more expensive than the last community that they built. So home prices on new construction in these premier luxury communities is not going down, it's going up. And I'll be the first to share if any of that changes. But for right now, they are offering almost no incentives. And the incentives that they are offering are really not incentives to begin with. If you use their lender, I think they give you 15 grand or kick you back some money in terms of closing costs. But if you're buying a 1.3 million home, 15 grand really isn't much to speak about. And trust me when I tell you, if you're using their lender, they're definitely making up whatever that credit or whatever that inducement is on the back end, 1000%. And that's just what it is. Now, that being said, that is not the case everywhere. And that's not even the case with them in other markets that are local. In fact, this morning I received an email from GL hyping up a much bigger incentive in the community of Arden, which is in Loxahatchee. And Loxahatchee is nice, but make no mistake, it's nothing like living in Boca Raton. And with that supply and demand dynamics for that community and the buyers who are shopping for that type of product in that community is very different than in other places, especially Boca Raton. But nonetheless, I received this email from GL Homes. Now, again, different sales team, different sales force, different community, different market. They're advertising bigger savings and faster move-in dates. And they're offering savings of $40,000. But keep in mind, it's Loxahatchee, it's Arden, it's a very nice community. But geographically, in my opinion, it's in the middle of nowhere and it's nowhere near as built out or robust or anywhere near the experience of what it would like to be to live in Boca Raton, which is where Lotus Palm is. And while these incentives may appear to be good, and they are, this isn't anything unusual. This is very similar to what they did in 2019. And back in 2019, when the inventory and demand were different, when we were in a buyer's market or a neutral market, or said a little bit differently, a very different market than anything we've experienced anytime recently. Builders were out there aggressively offering incentives. They were aggressively incentivizing buyers and brokers by paying bigger commissions. They were doing whatever they could in order to ensure they sold their product. But really, to me, this is not the canary in the coal mine. This is really more like a return to 2019 market conditions. But it is notable because they are starting to offer incentives and starting to do things differently. And I can assure you, if the pain of the recession continues to escalate at the rate that it is, at some point, everyone gets affected negatively. So if that trend continues, then I suspect builders and new construction will be doing lots of things to incentivize buyers to buy their home, and you will get a much better deal than at any point in the recent past. But for now, at least in my market, really none of those things have happened. We're just seeing a return to normal. But make no mistake, my friends, we are not in a normal economy. And I'm going to go into that right now. And let's talk about what's happening in the stock market, in the bond market, and let's look at businesses to see what the leading indicators are as it relates to what will happen in the near future. Because although real estate is a lagging indicator, the moves that billion-dollar companies make right now tell us a lot of information about where they see the economy, the recession, and even unemployment going. Now, before I get too ahead of myself, I want to be very clear that analysts are often wrong, that market forecasts are often wrong, that earnings expectations, estimates, guidance, forecasts, this, that, and the other are often wrong. And to be clear, almost every estimate and forecast that I've seen from the real estate industry as it relates to interest rates has been completely dead wrong, and we've blown past all those numbers substantially, which is just a long way of saying I don't believe what anybody tells me until I verify and do my own due diligence. I think it's important to understand that people who are in that space have a vested interest in maintaining calm, in not freaking out the market. They have a responsibility not to create panic. In many instances, some of these incredible professionals who have had success in many other places sound like they're talking out both sides of their mouth. But I remember when I was a stockbroker for 18 years and I was weathering the financial storm as it was happening in real time, and the markets were melting down, and the banking system was getting eviscerated, and there was real fear of bank failure throughout the country. There were plenty of professionals and plenty of talking heads that were offered easier, softer, more palatable forecast. And to best demonstrate this, and I've read your comments, and I know that there are plenty of people out there that tell me that CNBC is garbage, and any financial professional who listens to CNBC is an absolute moron. So I'm not here to debate you on that, but I do want to share what Jim Cramer had to say way back in the day, and I'll leave the judgments up to you. But nonetheless, this is what Jim Cramer told the public right as the markets were imploding.
Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No. Bear Stearns is fine. Do not take your money out. This is real. If there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
6 days later.
Okay, just so you get a sense of what's causing the agony by this point, I know you've been talking about it. It's financials led by Bear Stearns after what essentially is a bailout from the Fed. Bear Stearns shares are down 90% this morning. And
a bailout from the Fed.
Every single bank is plunging in early trade this morning. Lehman, which is very similar to Bear and its reliance on fixed income, is down nearly 30%. You have big names like Goldman Sachs down 8%, Citigroup down 8%. So it is pain across the board this morning, and as you know, it all emanates from the shock this weekend that JP Morgan, along with the Fed, was going to be bailing out Bear Stearns for $2 a share. This is a stock that recently was trading at 80. Last year was trading at 160. It is the fifth biggest bank on Wall Street. It is significant in that it is establishing a price for some of these hard-to-value securities, and as you are well aware, that price is pretty much zero, and that's why you're seeing pain across the street. Now,
I just want to make sure that everybody got that right. Bear Stearns went from $100+ stock down to zero in less than a year. But make no mistake, the Fed moves to insulate our economy to protect us from this systemic failure was not allowing free markets to do what free capital markets do. And the unintended consequence of those actions and many others is exactly why we're in the situation that we're in right now. But it's gotten much, much worse, which does not mean that you bury your head in the sand and hide your money under your mattress and suck your thumb. It doesn't mean any of that. But what it does mean is you must be prepared. You must do your due diligence. You must understand what is happening in the markets today. You must know what the leading indicators are and get the best information possible so you can go out there and make the best decisions for yourself, for your family, and for your financial bottom line. I hope you find this content valuable, and if you do, please subscribe, give it a thumbs up, share it with a friend, and just know that I love you for it. And ain't nobody gonna be uninformed on my watch. So that's what it looked like then, and now let's look at what's happening right now. And what's happened right now is that mortgage rates have surged to a new 14-year high. And the bond market and the bond traders that are out there are basically sitting on their hands and waiting to see what the Fed does. And the risk here that the Fed is going to take very strong action in order for them to combat inflation, which in the past, based on history, created a massive spike in unemployment that they did not anticipate the severity or the speed of, and brought us into a recession. I'm sorry, not a recession, a depression, the Great Depression. And it wasn't so great. And this one won't be great either. But to be clear, it doesn't mean it's going to happen, but it's a possibility. And we need to know what all the risks are and what the future could look like so that we can go out there, protect ourselves, position ourselves, and capitalize on weakness in the market where appropriate if it's right for you in any market. And I suspect if we see a big move from the Fed, they're going to continue to explode to the upside. And the trend here is not our friend. Now, I highlighted this section and I think it's very interesting because whoever wrote this said the exact same thing that I say all the time as it relates to the price of anything in any market. What they say is mortgage pricing is driven by what investors will pay. Well, it's the same thing with the housing market. The value of a home is not going to be contingent on what you think it's worth or what I think it's worth. It will be set by what a ready, willing, and able buyer is prepared to pay right now. And the bond market is no different. And the crypto market is no different. And for crying out loud, the baseball card market is no different, or stamps, or any other thing that trades in a market. The market is always right. And they go on to say that buyers are not paying up with the normal premium pricing, which means borrowers are forced to cover costs up front that might otherwise be absorbed by the investor premium. And that may have started to get a little bit too technical, but I'll say it in layman's terms. Interest rates are going higher and demand for that is plummeting. And here's what that looks like. Mortgage demand from home buyers falls 29% since last year as interest rates surge past 6%. No bueno if you're looking to use financing to buy a house, because now it's unaffordable, because it's a lot less affordable for most buyers. Not every buyer, but many buyers. And no bueno if you're thinking about selling your house, because now the demand from buyers, which just recently felt like an insane frenzy of buyers who were willing to do whatever it took to get their contract accepted, that doesn't exist anymore. But make no mistake, we still set records in today's market on the right homes priced the right way. But each market and the buyers shopping in that market are very different. And for the most part, by and large, and certainly in most other markets that are less pricey, buyer demand has fallen off a cliff. So what do we see right now as the Fed is meeting in front of the announcement that will happen tomorrow as it relates to their Fed funds rate? Well, what we see is that 2-year Treasury yields have reached 15-year highs. And while I'm not the smartest guy in the room, and some of you haters out there have gone out there and said realtors are idiots, I got news for you. I don't need to split the atom to understand where interest rates are going, but I do need to govern myself with the best information and common sense to be able to go out there and advocate for my clients and for all of you watching. Now, I know many of you are not prepared to buy a home right now. For many of you, buying a home right now is not the right thing. And one of the things that I talk about with crystal clarity with anyone that I intend to work with as I'm qualifying them to ensure they're making the right decision for themselves is, can you really afford this? Does this make financial sense? Are you secure in your job? Are you secure in your income? Are you secure in your savings? Are you certain about the timeline you intend to stay in this home? And for many people who want what they want when they want it and have the money to be able to do whatever they want, it's right for them right now. And they are thrilled about the opportunity to max out South Florida living to the fullest. But it's not everybody, and I understand that. So I think it's really important to dive a little bit deeper here and talk about what increasing inflation and increasing interest rates really mean to the consumer. And the first thing that's going to spike, which it's already happened, but it's going to get worse, is credit cards, specifically the annual percentage rate that you pay. And right now, prior to the Fed move, which is going to make it worse, we're already at an all-time high at 18% APR. And I'll say it differently. If you don't have credit card debt, then you're good. But if you're buried in credit card debt and you're making minimum payments and you're getting whacked at 18%, which is going to go higher, then chances are you're in some financial trouble that you need to be aware of. And I don't say this to scare you. I share it so that you can start to plan for how to minimize and save and get out of that debt trap. But if you think 18% is bad now, just wait. And if you think mortgage interest rates north of 6% are bad, just wait. Which brings us to the number 2 thing, which is mortgages. And as I already shared, mortgage interest rates are going to explode. And we've already seen that. So adjustable rate mortgages and home equity lines and 15 and 30-year mortgages, all of those interest rates are going higher. And with that, demand has fallen off a cliff and refis these days are basically non-existent. And relative to last year around this time, the payment for your home is up 60 to 100%, depending on which number we're using. It's become a lot less affordable. And now I really want to debunk something that I hear a lot of realtors saying, and it makes me freaking crazy. And what a lot of people are saying, which makes me nuts, is that you marry the house and you date the rate. And in a vacuum, that's probably an okay statement. But let me debunk it a little bit. If you cannot afford the payment for your home at the rate it is today, then don't buy the home. It's a bad decision because maybe interest rates will go down and you'll have an opportunity to refinance. But based on everything that I'm seeing and everything that I'm sharing and some of the leading indicators that I'm about to share, I don't see that happening anytime soon. Before you marry the house and marry the rate, understand if you can't afford it, you're going to be divorcing the house, divorcing the rate, and I hope you're not going to end up getting a divorce because you made a bad decision financially. And full disclosure, I am a professional realtor. I get paid when people buy and sell homes. So I'm not trying to talk you into or out of anything, but I am trying to ensure you've got the best information so that you can make the best decisions for yourself. Because truthfully, I don't want you to buy a home if it's going to put you at financial risk or make you unhappy in the future. So having these hard talks up front is my job. And the first step that I would encourage anybody who's thinking about buying at any point is to have a conversation with a lender, but more specifically, a lender that I know, like, and trust and will be happy to refer you to, because I know they will do a deep dive and a thorough analysis as to ensure you know exactly what you are saying yes to or no to. And there will be no uncertainty as it relates to the financial obligation that you are considering. Which takes us to auto loans. And please don't get me started. I've done a lot of content in the past talking about the subprime auto bubble that is bursting or has burst or is going to continue to get worse. But just know that inflation is absolutely driving the price of vehicles through the roof, and the financing terms around those purchases are insane. And while, yes, not every loan is the same, and the subprime loans are worse than non subprime loans, just understand if you don't do the same due diligence that you would in purchasing a home when you're purchasing a car, then you're set up for a repo. And right now, that industry is so messed up that the banks who are trying to repo these cars, because there are so many defaults within the industry, they're not even auctioning the cars because if they do, they absorb the loss. And if they absorb the loss, or said differently, if they realize the loss, then very soon many of those lenders will be out of business because they're insolvent. Which takes me to the next section, which is student loans, which will absolutely feel the pain of the inflation and of increased interest rates based on Fed moves. And the student loan situation makes me sick. But honestly, nobody cares if it makes me sick or not. The student loan industry is in the business of making money. And make no mistake, the interest rate on that debt or on that loan, which if utilized and maxed out to the fullest, probably leaves you with a completely useless degree that doesn't increase your earnings power, but that's a different story for a different day. Just know that the rates on student loans are tied to the 10-year treasury, and those rates are going higher. But I guess the silver lining here is, although it's not really a silver lining, it's really a brown colored lining, if you know what I mean, insert poop emoji, but you may be eligible for a federal student loan forgiveness program, which I'm not going to get started on. That stimulus and that forgiveness is a massive disaster waiting to happen too. But I don't want this video to be 3 hours long and I want to stay on task. But just understand student loans are about to get much more expensive. Which finally takes us to saving accounts. And isn't that a cute little piggy? No, I'm not talking about Nancy Pelosi. But one could make an argument that the increased interest rates will have an impact positively on savings yields. But please understand, those yields are nowhere near close to matching what inflation is. So if your money is in a savings account, just know it is losing value relative to inflation on a day-to-day basis. And separate to that, the banks are charging so many different fees that any interest that you actually are earning is probably going to be eaten up by those fees. But to tie this up in a positive note, the yields on savings accounts could be going higher, which I'm sure is going to make everybody feel wealthy. So congratulations, we got some good news. Now, recently in the past, I've done lots of content talking about leading indicators, looking at what corporations are doing right now to protect themselves in the future. And I'm not going to do a deep dive on all of these companies. I've done that in the past, and you're welcome to check out those videos, which will be linked at the end of this for you to watch or in the comments down below. But Amazon, Bed Bath & Beyond, and FedEx are all making moves right now to protect themselves financially from inflation. And that includes layoffs, and that includes halting expansion. It has halted or closed the production of many new facilities. And while that might not seem like a big deal in the news headline, it has a massive impact on the economy of the local surrounding area of where those stores or supercenters or shops or distribution centers are. And the pain and ripple effect from that move is going to take time to actually be felt. But make no mistake, the pain will be felt. That's when you start to see distressed sales. Which now takes me to Ford. And now I have no idea how you feel about Ford as a company, but they're one of the largest American automakers that exist. And they've been around forever. And in the last financial crisis, when they were about to go under, stock was trading somewhere between $1 or $2 a share. And to go backwards in time and share what I thought in that moment as a stockbroker, trading around weakness and positions like this, I saw what was happening in terms of bailouts. I saw what was happening in terms of stimulus. And I believe in America. And so when Ford was at $1 and Bank America was at $1, or maybe it was 2, I don't exactly remember, I bet on America, and I will continue to bet on America. And I loaded the boat and built massive positions for myself and clients in these completely battered, undervalued companies. And so did Warren Buffett. And Warren and my clients and myself made more money on those trades than at any other time in my career, which is why I tell people to keep powder dry and be opportunistic and ready to pounce when you find an undervalued situation. To be clear, I'm not talking about a home purchase right now. I'm talking about stock investing. Because if you're buying a house, it's not an investment. You're buying that house to live in. I'm not tone deaf. I understand it is a large investment. But I also know that over time, no matter what happens to the value of that property during the recession or during the crash or during the correction or during whatever happens, I know for certain, I believe in America, I believe in our economy, and I know for certain that over time, that is the best hedge that we have against inflation, and your home will be worth more over time. So being crystal clear on your timeline is very important. So let me bring this back to Ford and what they're saying right now. And they warn investors of an extra billion in supply chain costs during the third quarter. That's not exactly surprising to me. We're seeing that across the board in almost every sector, in almost every space, and in almost every company. So the question I ask myself is, what will these companies do in order to retain and ensure their profitability and their earnings power? Well, thanks for asking. And here's what I suspect will happen across the board over time in almost every industry that they can do it in. And the ugly word is automation. Automation. Said differently, these companies will make the capital expenditure necessary to ensure they can bring down their labor cost over time. And the easiest way for them to do that is to automate. So there are going to be many jobs that are displaced by automation, that will be displaced by AI and computers, that will be displaced by whatever the next technology is. But make no mistakes, that is where corporations are going, and that will impact the economy and the consumer negatively. I realize I'm all over the place here. There's so much content that I think is relevant for you to understand, and I'm going to bring in energy here for a second because I've read your comments. Some of you are out there with the misconception that energy and fuel give us some sort of competitive advantage economically. And that could be true in the future if there is a massive change in policy. But the truth is, right now, our strategic petroleum reserve, the National Strategic Petroleum Reserve, which is meant for emergencies, which is meant for times of war, is meant for national disasters, is not being used for any of that. It's being used to subsidize lower prices at the gas pump. Which means although we're still paying an insane amount of money for a tank of gas, we're depleting our strategic reserve. So, God forbid any of the things that are happening geopolitically or internationally, meaning Russia, meaning China, meaning Taiwan, and understanding we have the biggest threat to national security and potential war than we have since the Cold War. In spite of those things, we're tapping our national reserve. And so we're starting to see some consolidation. We're starting to see some moves within that sector. There's an analyst out there at KeyBank that says buy Diamondback Energy, which can rally 25% as the US struggles to meet oil demand. Now, I don't know anything about that trade, and I'm not suggesting that you take them up on their advice, but I do want to illustrate the point. We're at more risk now because of some of the policy moves that we're making as it relates to our National Petroleum Reserve than we have been since 1975, which is not good. So as I mentioned, when I started making this video, it was pre-market, but I've talked so long that the market has actually opened. And the market doesn't like anything about what they think the Fed is going to do in this meeting. And we've got a 300-point drop on that. And the impact that has on the psychology of the market and the consumer is not good. And based on what I see right now, 30-year fixed rate is 6.42%. And please bear in mind, and if you've watched my videos in the past, you know I'm on the record with this, I suspect interest rates will be somewhere between 8 and 10% by the end of the year. But I could be wrong. It could be tomorrow or never. But the trend is not our friend. So it's important that you understand what's happening in real time so that you can govern yourself accordingly. And so right now I'm going to veer off into a different subject matter than I usually talk about. And please stay with me because I am going to tie this back to housing and the housing market and exactly what's happening in my market so that you know how to govern yourself accordingly. But I've had so many people reach out. In fact, I got an email this morning from some asking about how I made money for my clients during the worst financial crisis when I was a stockbroker. And before I get into some of the speculative trades that I did in order to capitalize on sector and market weakness, I absolutely want to share the most prudent way to invest in the stock market is by finding a no or low cost index fund that trades in parity with an index. And you can get much more sophisticated and find different ETFs that have no cost or no load and do the same thing I'm about to share. But I'll share what I did and what I've done for my entire life before I was a stockbroker and up until now. It's a very simple strategy. It is 1000% effective. And you don't have to take my word for it. Don't take my word for it. You can go out there and Google what Warren Buffett says. But really, what we want to do is maximize compound interest over time. And I'm going to make this very, very simple and easy to understand. And it's the exact same thing that I've been teaching my daughters who are 7 and 8 years old. And the real secret to this, although it's not a secret, is to start early. And here's what it is. Drum roll, please. If you've heard this before, then thank you for humoring me. But it's a very simple concept. Allocate a number that you are comfortable with investing. The more you do, the more effective it is. But I don't know what's right for you, and I don't know your finances. And hopefully you've already been doing this for decades. So this is probably not relevant to you. But anybody who's out there watching, and I can see the analytics, there is definitely a younger demographic that watches this content. But the best advice that I could give anyone, it's the same advice that I followed myself and what I'm teaching my daughters, is to take a small amount of saving, invest that into an index fund that you set and forget. And it automatically dollar cost averages the same dollar amount on a weekly, monthly, or quarterly basis, or whatever contribution schedule you set up. But the more you do, the more effective it is. And the earlier you start, the better it is long term, because this is a compound interest play. It's fully automated. So every time you make a contribution to the account, it will then automatically purchase the dollar amount of the ETF or whatever product it is that you've chosen. But full disclosure, make sure there are no fees involved, because those fees are going to absolutely eat away in your success at this strategy. Set it and forget it. Start young, start early, start often. And over the course of 20, 30, 40, 50, 60 years, your minimal contribution will grow exponentially. And by the time you retire, you'll be looking at a multi-million-dollar return on your investment. And it's not from doing anything fancy. It's simply from being disciplined and continuing to stay the course throughout every market cycle. So whatever dollar amount it is that you're investing over time, you will absolutely buy at lows, you will absolutely buy at highs. But if you ever veer from the strategy and panic and pull out of that strategy and you miss any of the dips, well, then this whole discipline is for nothing and you will miss out on the opportunity. But similar to a home, and you've got a long timeline, and you've committed to 30 to 40 to 50 years or whatever timeline it is, obviously this would be a different conversation for each different person based on age and the amount of money they can contribute. It's 100% effective and it will most likely outperform any other investment over time. It's not sexy, it's not glamorous, and it's probably not even fun. But at some point in the future, it's going to be phenomenal. So enough about my rudimentary stock advice. And now I'll be more granular as to how I capitalized in a much more speculative way for accredited investors that had the risk tolerance to speculate. But what I saw within the market was very obvious patterns of weakness in different sectors. And so when the market was collapsing and the financial markets were collapsing, it was very obvious to me that if there was an index fund that allowed me to capitalize on the weakness in a sector or the strength in a sector, I could trade around binary events and make my clients and myself a fortune. And so that's what I did. Now, full disclosure, none of this is investment advice. I am no longer a Series 7 stockbroker. I am not licensed. I am not a professional, although I was one for 20 years. I do not have any of the authority or the licenses to give you any type of investment advice. So that is not what this is. This is me telling you a story of things I've done in the past, which worked out very handsomely for my clients. And to be clear, Direxion, the ETF that I'm about to share with you, and their family of funds was very different when it first started than it is right now. And what I mean by that is the institutional money that was in the product, the lightning speed trade that exists now that give them a competitive advantage. None of those things were true when these products first came out. So there was much less volume and they traded with much more volatility, which is great because I was looking to capitalize on volatility. And so I found products that allowed me to do so. And the really cool thing was for risk tolerant speculative investors, there were even better products which allowed me to go out there and not use margin, because I wouldn't suggest anyone does that, especially in the environment that we're in right now. But I could buy an ETF that was triple levered or double levered, which meant that it got 3 times the movement or 2 times the movement of the volatility that existed in that sector. So when I knew there was weakness in a sector like the housing industry, I would go to a builder ETF and I'd find the ETF that allowed me to capitalize on weakness in that sector. And I would trade it. So we did that with energy, we did that with financial companies, we did that with builders, and we made our clients a fortune. So learning about these products and some of these strategies is probably a good idea if you've never heard of them before and it's right for you. But make no mistake, just like in the housing market where I say there's no such thing as a bad market, it's always a good market for someone. The same is true of every other market too. And so please know there are plenty of investment vehicles and plenty of investment opportunities that exist if it's right for you and your risk tolerance is high enough and you've got the money and are willing to gamble. Because make no mistake, everything that I'm talking about right now is highly speculative and you could very easily lose all your money, especially if you're not using the right broker. So similar to real estate, if you're working with the wrong professional, you are very likely to take on a lot more risk than you need to. So do your due diligence, do your homework. But if you're interested in learning more about these strategies, or if you're interested in being connected with a professional who I know, like, and trust, that will help determine if this is right for you, please reach out, shoot me an email, and I'll get you connected right away. But enough about stocks, and let's tie it back up with real estate and where we're at today. And here's where we're at today. Right now in South Palm Beach County, the market is changing fast. And if you're thinking about buying, there's a lot more inventory and a lot more leverage for you to be able to go out there and negotiate a phenomenal deal if it's right for you. And if you're thinking about selling, Keep hope alive, because the truth is buyers are still buying. And if you price and market your home the right way, there's no doubt that you will find the one buyer on planet Earth willing to pay more than anyone else. But it's not going to be a feeding frenzy, and it's not going to happen instantly. And you must hire a real estate professional that can advocate for you so that you get what you want. Which takes me to a content piece that I did a few weeks ago, showcasing a luxury home in an incredible community that I shared on YouTube. But I also ensured it got in front of every single buyer who was looking for a home similar to this. And some of your comments on this video were nasty, and you told me that it would sell for half price. But the truth is, this video connected me with 3 buyers, one of which went out there and was thrilled to buy the home for cash at full price, while the rest of the inventory in that same community has sat stale. And it only took 18 days, which might seem like a long time relative to what it was like a few months ago. But relative to any other time in history, a full price cash offer in 19 days is exceptional. And we can do the same for you. Now, I notice a lot of you who watch are not local in my market, but please understand that we can serve and support you at the highest level, no matter where you are in the country. So if you're thinking about moving and need a real estate professional that we know, like, and trust, that will get you exactly what you want, irrespective of market conditions, then please opt in for a referral and we will get you set up right away. And more importantly, please check out one of the 2 next videos that will be in either corner, because I suspect you will love them a lot. And if you found this content valuable, please give it a thumbs up, subscribe, share it with a friend. And if you're even thinking about moving to or living in South Florida, you've got to give me a call, text, DM, send a carrier pigeon, a smoke signal, by any means necessary, because we've got your back when it comes to moving to or living in South Florida. And until next time,